Let me tell you about a man named Arthur Delgado. Arthur was a shop teacher in Clark County, Nevada for 31 years. He spent 3 decades breathing sawdust and teaching teenagers how to build bookshelves they would never use. And every single paycheck, Arthur did what he was told. He maxed out his 403B. He rolled it into a traditional IRA when he retired. He named his son Mark as the sole beneficiary. He kept the original beneficiary form in a fireproof lockbox next to his discharge papers and his late wife's wedding ring. Arthur did everything right. He sat in the seminars. He nodded along when the credit union advisor told him his son would be set for life, and Arthur believed it, because the rules made sense. Mark could inherit the IRA, stretch the withdrawals over 40 years, pay almost nothing in taxes, and live well knowing his father built something real. That was the promise. Arthur passed away in March of 2024 at age 79. He left behind a $400,000. Traditional IRA, a paid-off house, and a son who loved him. Within 60 days, the Internal Revenue Service began confiscating nearly $90,000 of that money. Not through a lawsuit, not through a lien, not through a lien dollars of the god, through a law Congress passed in December of 2019 that Arthur never heard about, that his advisor never mentioned, and that Mark did not understand until a CPA explained that his father's retirement account was a tax bomb with a 10-year fuse. That is what this video is about. Not theory, not speculation. This is happening right now in 2026 to families who believe they are leaving their children an inheritance when they are actually leaving them a tax bill that would make a bankruptcy attorney flinch. If you are a retiree with a traditional IRA or a 401k and you have named your adult child as the beneficiary, you need to watch this entire video. Do not skip ahead. Every sentence is a loaded weapon pointed at the IRS playbook designed to strip mine your family's wealth the moment you are no longer alive to fight back. And before we go any deeper, I need you to do something for me. I need you to smash that like button right now. Not because I care about vanity metrics, because in 2026, the algorithm is actively suppressing financial education content for seniors. Every like, every share, every comment tells the system that this information matters, that retirees deserve to hear the truth about what is being done to their money. So hit that like button, subscribe to this channel if you have not already. Flip the notification bell so you are the first to know when the next episode drops. And if you are watching this on your phone, save this video to your private library right now. Bookmark it. Screenshot the timestamp. Because when the IRS sends your family a letter they are not expecting, this video is the survival manual you are going to need. Now let me explain exactly what happened to Arthur's family, because what happened to them is about to happen to yours. For decades, the tax code allowed something called the stretch IRA. If you inherited a traditional IRA from a parent or grandparent, you could take required minimum distributions based on your own life expectancy. If you were 45 and inherited a $500,000 IRA, you could stretch withdrawals over 40 years. Small amounts each year, modest tax, and the rest of the account kept growing tax deferred. It was one of the most powerful wealth transfer tools in the tax code. Middle-class families used it to build generational stability. A teacher could leave an IRA to a daughter who could leave the remainder to a granddaughter, and the account would compound for decades. That was the deal. Congress broke that deal. In December of 2019, they passed the Setting Every Community Up for Retirement Enhancement Act, the SECURE Act. They marketed it as a pro-retirement bill. They put the word enhancement right in the title as if they were doing you a favor. And buried inside that bill in a provision that received almost no media coverage, Congress eliminated the stretch IRA for the vast majority of non-spouse beneficiaries. In its place, they installed the 10-year rule. That rule is the reason Arthur Delgado's son is about to write a check to the federal government for $90,000 that his father never intended the government to have. Here is how the 10-year rule works. When a non-spouse beneficiary inherits a traditional IRA from someone who died after the 31st of December 2019, that beneficiary must completely liquidate the entire inherited IRA within 10 years of the original owner's death. Not 10 years from when they feel like starting. 10 calendar years from the date of death, and the clock starts on January 1st of the year after the owner dies. It gets worse. In July of 2024, the IRS published final regulations clarifying how this 10-year window operates, and the answer is more punishing than most tax professionals expected. If the original IRA owner died after their required beginning date for RMDs, which in 2026 means after age 73, the beneficiary cannot simply wait until year 10 and empty the account. The beneficiary must take annual required minimum distributions in years 1 through 9, calculated using the IRS single life expectancy table, and whatever remains must be withdrawn by December 31st of the 10th year. It is a forced annual extraction plus a final deadline. The IRS designed it so you cannot strategize withdrawal timing if the original owner was past their RBD. Here is the critical piece nobody is talking about. The IRS waived penalties for misinherited IRA-RMDs from 2021 through 2024 while finalizing the regulations. That waiver is gone. Starting in 2025, if you miss an annual RMD on an inherited IRA and the original owner died after their required beginning date, the penalty is 25% of the shortfall. If you correct it within 2 years, it drops to 10%, which sounds generous until you realize you are paying a penalty just to access money your parent paid into the system for 40 years. If you fail to empty the account by year 10, the remaining balance triggers the penalty on the entire amount. This is a steel trap with a timer. Now, let me walk you through the math, because the math is where the outrage lives. Let me take you back to Arthur and his son Mark. Arthur left a $400,000 traditional IRA to Mark. Mark is 45 years old. He is a project manager earning $90,000 a year. He is single. He files as a single filer. Under the old stretch IRA rules, Mark could have taken small distributions over the next 40 years, roughly $10,000 a year, staying comfortably in the 12% bracket, paying minimal tax, and letting the rest of the account grow. The total tax bill over 40 years might have been $50,000 or $60,000 spread out so thin he would barely notice it. That option no longer exists. Under the 10-year rule, Mark must liquidate the entire $400,000 within 10 years. Arthur died at 79, well past the required beginning date of 73, so Mark must take annual RMDs in years 1 through 9, plus a final distribution in year 10. Assuming Mark withdraws $40,000 per year, here is what that does to his tax return. Without the inherited IRA, Mark's gross income is $90,000. His 2026 standard deduction as a single filer is $16,100. That gives him a taxable income of $73,900. Under the 2026 federal tax brackets, confirmed by IRS Revenue Procedure 2025-32, his tax breaks down like this. The first $12,400 is taxed at 10%, which is $1,240. The next $38,000 from $12,401 to $50,400 is taxed at 12%, which is $4,560. The remaining $23,500 from $50,401 up to his taxable income of $73,900 is taxed at 22%, which is $5,170. Total federal income tax on his salary alone, $10,970. Mark's marginal rate on his salary is 22%. Now add the $40,000 from the inherited IRA. Mark's gross income jumps to $130,000. After the standard deduction of $16,100, his taxable income is $113,900. And here is where Congress springs the trap. The first portion of that income is taxed exactly the same as before through the 22% bracket. But now Mark has $8,200 of taxable income sitting above $105,700, which is where the 24% bracket begins for single filers in 2026. That $8,200 is taxed at 24%, adding $1,968. His total federal tax with the inherited IRA distribution is $19,934. The additional federal tax caused solely by the inherited IRA withdrawal is $8,964 in a single year. Multiply that by 10 years. Mark pays approximately $89,640 in additional federal income tax just to access the inheritance his father spent 40 years building, and that is federal tax only. If Mark lives in a state with income tax, the damage compounds. In California, that additional $40,000 pushes him deeper into the state's graduated brackets. In New York, same story. When you combine federal and state taxes, the total tax hit on that $400,000 inheritance can reach $100,000 to $120,000, wiping out 25 to 30% of Arthur's life savings before Mark ever sees a usable dollar. I want you to sit with that number. Arthur worked for 31 years. He saved for 4 decades. He sacrificed vacations, new cars, home renovations. He put money into that retirement account every paycheck because someone told him it was the responsible thing to do. and the government's reward is to confiscate roughly a quarter of everything he built, not through estate tax, but through forced ordinary income tax on his children. This should make you furious. Tell me in the comments right now, were you planning on leaving your 401k or IRA directly to your children without realizing the IRS will tax it as ordinary income? I want to hear your field reports. Tell me what your financial advisor told you about this. Tell me if they even mentioned the SECURE Act. Tell me if they are still using the phrase stretch IRA as if it still exists, because I guarantee you some of them are. Now, let me show you what happens when you scale this trap up. Consider a retiree with $500,000 in a traditional IRA who names their 45-year-old daughter as the sole beneficiary. The daughter is an engineer earning $120,000 a year, single filer. Under the 10-year rule, she withdraws $50,000 per year. Her gross income jumps to $170,000. After the standard deduction, her taxable income is $153,900. She is deep into the 24% federal bracket, which for single filers runs from $105,701 to $201,775. Her additional federal tax from the inherited distributions is approximately $11,964 per year. Over 10 years, roughly $119,600 in federal tax alone. Add California's state income tax, and you are looking at $140,000 to $160,000 in combined taxes on a $500,000 inheritance. That is 30% or more of her father's life savings, not because of bad investments or market crashes, but because Congress decided your children's inheritance was a revenue source they could tap. The government did not change the retirement laws to help your family. They changed them to ensure the IRS gets the biggest possible cut of your life savings before your children see a dime. That is not conspiracy theory. That is the Congressional Budget Office's own scoring. The 10-year acceleration was projected to generate billions in additional federal revenue. Your family's inheritance is a line item in a budget projection. Send this video to one retiree you care about, not tomorrow, today. One conversation now saves them $75,000 later. Send it to the parent who proudly talks about the retirement account they are leaving for their kids. Send it to your brother, your sister, the person at church who just retired. Their financial advisor has not had this conversation with them. Now let me show you how this trap works differently in 3 states because the damage is not uniform across the country. In Florida, there is no state income tax. A Florida retiree's children pay federal tax only on forced distributions, roughly $89,000 to $90,000 over 10 years at the income levels we discussed. But Florida has its own trap. Florida's probate process is expensive. And if the IRA beneficiary designation is botched, if the form was never updated after a divorce, if the account defaults to the estate, that IRA gets dragged into probate, triggering the 5-year rule instead of the 10-year rule. Florida retirees must verify their beneficiary designations every year. In Ohio, the story changes. Ohio imposes a state income tax with a rate of 3.5% on income above $26,150 after recent reforms. Mark living in Ohio would pay an additional $1,000 to $1,400 per year in state tax on the inherited IRA distribution. Over 10 years, Ohio adds $10,000 to $14,000 to the total bill. Ohio eliminated its estate tax in 2013, but the income tax on inherited IRA distributions is a backdoor inheritance tax most Ohio families never see coming. In California, the damage is catastrophic. California's top marginal rate is 13.3%. A California resident inheriting that $400,000 IRA and withdrawing $40,000 per year pays state income tax at roughly 9.3% on the inherited portion. That is an additional $3,700 per year, approximately $37,000 over 10 years, on top of the $89,000 in federal tax. Total combined hit in California, approximately $126,000 on a $400,000 inheritance, nearly 32%, 1/3 of everything Arthur built gone, split between Sacramento and Washington with no legal recourse and no appeal. Let me hit you with one more layer that almost nobody discusses. When Mark withdraws $40,000 from the inherited IRA, that additional income does not just push him into a higher bracket. It triggers collateral damage across his financial life. Income-based tax credits phase out as income rises. If Mark is repaying student loans on an income-driven plan, his monthly payment increases because his AGI jumped $40,000. If Mark contributes to his own Roth IRA, the additional income could push his modified adjusted gross income above above the Roth contribution limits, which for single filers in 2026 begin phasing out at $150,000. Mark at $130,000 is getting close. If Mark has children and claims education credits, the additional income can reduce or eliminate those credits. The inherited IRA distribution is not just a tax event, it is a financial grenade that sends shrapnel into every corner of Mark's financial life. Now here is the part where I tell you how to fight back. What Arthur should have done, what every retiree watching this needs to understand, is that the tax rate your children pay on their inheritance is not determined by Congress. It is determined by you right now, while you are still alive and still have the power to choose. The strategy is called a Roth Conversion. Here is how it works. A Roth Conversion moves money from a traditional IRA, where it sits pre-tax, and will be taxed as ordinary income when withdrawn into a Roth IRA, where it grows tax-free and comes out tax-free. You pay income tax on the converted amount in the year you convert. But here is the insight that changes everything. You choose when you pay that tax. If you are retired, if your income has dropped, if you are sitting in the 12% bracket with room to spare, you pay a fraction of what your children will pay if they inherit the money in a pre-tax account during their peak earning years. Let me walk you through Arthur's scenario the way it should have been done. Arthur retires at 65. His pension and Social Security give him a gross income of roughly $48,000 per year. He is single. After the 2026 standard deduction of $16,100 plus the additional standard deduction for taxpayers over 65 of $2,050 plus the senior bonus deduction created by the One Big Beautiful Bill Act of $6,000, Arthur's total deductions are $24,150. His taxable income from pension and Social Security is approximately $23,850. That puts him in the 12% bracket, which for single filers in 2026 runs from $12,401 to $50,400. Arthur has room. He has $26,550 of space left in the 12% bracket before he hits the 22% threshold. Every year, Arthur can convert $26,550 from his traditional IRA to a Roth IRA and pay only 12% federal tax on that conversion. That is $3,186 in tax per year. Some years, Arthur might choose to fill part of the 22% bracket as well, converting additional funds at 22%, which is still dramatically lower than the 24% his son would pay. If Arthur converts $26,000 per year at 12%, it takes him approximately 15 years to convert the full $400,000. That is a long timeline, and it requires starting early in retirement. But look at the numbers. $400,000 converted at an average rate of 12% costs Arthur $48,000 in total federal income tax over those 15 years. Compare that to Mark's scenario of inheriting the pre-tax IRA and paying $89,640 in additional federal tax over 10 years. Arthur's proactive Roth conversion saves his family approximately $41,600 in federal taxes alone, and that is the conservative estimate. If Mark lives in a state with income tax, the savings multiply because Roth distributions are tax-free at the state level too. In California, the total savings could exceed $60,000, but the tax savings are only half the story. When Mark inherits a Roth IRA instead of a traditional IRA, he is still subject to the 10-year rule. He must still empty the account within 10 years. But here's the difference that changes everything. Every single dollar Mark withdraws from the inherited Roth IRA is 100% tax-free. No federal tax, no state tax, no impact on his adjusted gross income, no bracket creep, no loss of credits, no increase in student loan payments, no threat to his own Roth IRA contributions. The money comes out clean. $400,000 minus the $48,000 Arthur already paid in conversion taxes means Mark inherits approximately $352,000 that he can access over 10 years without owing the government a single cent. Compare that to the pre-tax scenario where Mark inherits $400,000 on paper, but keeps only $310,000 after federal tax, or $274,000 after combined federal and California state tax. The Roth conversion does not just save money. It transfers control from the IRS back to your family. Now, I want to pause here and give you something you can use today, because strategy without action is just philosophy. Save this video right now, add it to your favorites, bookmark it. This is your survival manual for protecting your family's inheritance, and you are going to need it when you sit down with your financial advisor and demand that they explain why they never brought this up. Here is your 7-step action plan, and I want you to write these down or screenshot this section of the video because each step matters. Step 1. Pull your IRA and 401k beneficiary designation forms today. Not next week, today. Confirm who is listed. Confirm the account is not defaulting to your estate. If it defaults to your estate, the 10-year rule may not even apply, and your heirs could be stuck with the 5-year rule, which is even worse. Contact your custodian, whether that is Fidelity, Schwab, Vanguard, or whoever holds your account, and request a current copy of your beneficiary designation. Put it in writing. Get confirmation. Step 2. Determine whether you have passed your required beginning date for RMDs. In 2026, the RBD is April 1st of the year after you turn 73. If you are 74 or older, you have passed it. This matters because it determines whether your beneficiaries will face annual RMDs during the 10-year window or just the year 10 deadline. If you are under 73, your beneficiaries get more flexibility in timing their withdrawals, which gives them a slight tax planning advantage. Step 3. Identify your children's current and projected tax brackets. Call them. Ask them what they earned last year. Ask them what they expect to earn in 5 years, in 10 years. This is not a casual conversation. This is a financial triage assessment. If your daughter is a single filer earning $120,000, she is already in the 22% bracket and will be pushed into 24% by inherited IRA distributions. If your son is married filing jointly earning $200,000 with his spouse, the additional inherited income could push them toward the 32% bracket. You need to know their numbers before you can protect them. Step 4. Calculate your available Roth conversion space. Look at your current taxable income. Subtract it from the top of your current tax bracket. The difference is your conversion space at your current marginal rate. If you are in the 12% bracket with $26,000 of room, that is your annual conversion budget at 12%. You can convert more and pay 22% on the excess, but you need to decide whether paying 22% now is better than your child paying 24% later. In most cases, it is. Step 5. Execute the Roth conversion with your custodian. Call Fidelity, Schwab, or Vanguard and tell them you want to convert a specific dollar amount from your traditional IRA to your Roth IRA. You will receive a 1099-R showing the conversion as taxable income. Pay the conversion tax from a non-retirement account. Do not pay it from the IRA itself because that reduces the amount converted and triggers an additional taxable event if you are under 59.5. Step 6. Update your beneficiary designations to reflect the new Roth IRA. Your children should be named as beneficiaries on the Roth IRA, not the traditional IRA. If you are converting over multiple years, you may have both a traditional and a Roth IRA simultaneously. Make sure the beneficiary forms are current on both accounts. Review them annually. Step 7. Document your conversion strategy in writing. Write a letter to your children explaining what you did and why. Include the account numbers, the custodian contact information, and a copy of the beneficiary designations. Put this letter in the same fireproof box where Arthur kept his forms. Your children need to know that when you pass away, they are inheriting a Roth IRA, not a traditional IRA, and that the withdrawal rules are different. They need to know that every distribution is tax-free and that they have 10 years to empty the account. This letter could save your family from making a catastrophic mistake during the most emotionally difficult period of their lives. Now, let me tell you what the Retirement Insurgent has built for people exactly like you. At retireeshieldreport.com, I have put together a free resource that walks you through the Roth conversion timeline, the bracket math, and the beneficiary designation checklist in a format you can print and take to your advisor. This is not a sales pitch. This is a field manual. Go to retireeshieldreport.com, download the report, and use it as your starting point. Because your advisor should be having this conversation with you, and if they are not, you need to walk into their office with the math already done and demand an explanation. Let me talk about one more scenario before I close. I know someone watching this is thinking they can outsmart the 10-year rule by not taking distributions and paying the penalty instead. Do not do this. The SECURE Act 2 reduced the penalty from 50% to 25% of the shortfall, and it drops to 10% if corrected within 2 years. But even at 10%, if Mark skips a $40,000 RMD, the base penalty is $10,000. If he skips multiple years, the penalties compound with interest. There is no scenario where ignoring the 10-year rule saves money. The only defense is the Roth conversion, and the only time to do it is while you are alive and in a lower bracket than your children. I also need to address the retirees watching this who are thinking about qualified charitable distributions as an alternative strategy. A QCD under IRC Section 408 D8 allows you to send up to $105,000 per year directly from your traditional IRA to a qualified charity. The distribution satisfies your RMD. It does not count as taxable income, and it reduces the balance of the IRA that your children will eventually inherit. If you are charitably inclined, a QCD is a legitimate tool for reducing the size of the inherited IRA tax bomb, but it is not a substitute for Roth conversion. It is a complement. You can use QCDs to satisfy your RMDs, reduce the IRA balance, and simultaneously convert additional IRA funds to Roth. The two strategies work together, not in isolation. Here is where I give you the disclaimer. The suits want me to tell you this is not financial, legal, or tax advice, that I am not your advisor, your CPA, or your attorney. And technically, they are right. You should work with a fiduciary advisor and a CPA who understands the SECURE Act and Roth conversions. But if your current advisor has never mentioned the words Roth conversion, if they have never explained the 10-year rule, if they are still using the phrase stretch IRA as if it exists in 2026, then they are not advising you. They are managing your account and collecting a fee while your family's inheritance bleeds out. A real advisor would have had this conversation 5 years ago. If yours has not, you have a decision to make. I want to close with one number that should keep you awake tonight. Arthur's reliance on outdated inheritance rules cost his son approximately $90,000 in forced federal taxes. In California, that number climbs to $126,000. That is a quarter to a third of the wealth Arthur spent 40 years building evaporated in a decade because nobody told Arthur that the rules changed. The moment you pass away, the 10-year countdown clock locks in for your children. There is absolutely no way for them to undo the tax burden once the account is transferred. They cannot convert an inherited traditional IRA to an inherited Roth IRA. That option does not exist. The conversion must happen while you are the account owner. Once you are gone, the window is closed forever. Go to retireeshieldreport.com, download the report, print the checklist, pull your beneficiary designations, call your children and ask them what tax bracket they are in. Sit down with a fiduciary advisor who actually understands the SECURE Act, not one who is still selling you on a plan that expired 6 years ago, and share this video with one retiree you care about. One conversation now saves them tens of thousands of dollars later. That is not an exaggeration. That is the math, and the math does not negotiate. And before you try to protect your family's inheritance by putting your child's name directly on the deed to your house, you need to watch the next video, because the joint tenancy trap triggers an automatic capital gains confiscation under IRC Section 1014 that could cost your family the step up in basis on your most valuable asset. That video drops next week. Subscribe and hit the bell so you do not miss it. The system is counting on you being too late. Do not give them the satisfaction.